Depreciation of real estate assets is tax deductible. In Canada, depreciation in real estate is called the capital cost allowance, or the CCA. So the first step is to calculate the depreciable base, which is the market value of the building. Meaning that we are just looking at the value of the building, not the value of the land. Once we have the depreciable base calculated, we will use the straight line method to find the depreciation for US properties. For some reason, in the US, for non-residential properties like offices and malls, depreciation is spread over 39 years. Why 39? I don't know. For residential properties in the US, it's 27.5 years. And, in the US, depreciation it's done in a straight line method. Meaning that each payment stays constant. So, all you have to do is remove 1/39th of the value of the building every year. Remember, it's just 1/39th of the value of building, not 1/39th of the land. The advantage of doing a straight line depreciation is that the amount is constant. Now, the system for depreciation in Canada is different. In Canada, property depreciation is called capital cost allowance. And it is done at a percentage of value of 4%. So, you can depreciate your building by 4% of its remaining value each year. The only exception is with the first year, which is done with a rate of 2% on the total depreciable base. Why the 2%? 1. Real estate investors won't be able to take advantage of the system by getting the 4% on the total value of the building. Usually, properties have greater value at the time of the acquisition and then depreciate over time. So a 2% rate for year 1 softens the curve. For instance, instead of being a 10K write-off in year 1, it'll be 5K. Then, the year 2 depreciation write-off will be 4% for an amount of 9.8K. So, instead of being 10, then 9.8. It's 5, then 9.8. It basically encourages a longer hold instead of just flipping the property. 2. The 2% rule allows for less timing of the market. Since the normal 4% depreciation applies at the beginning of each year, an investor can buy a property in the last days of the year, get the 4%, then get another 4% a few days later. So, the 2% rule mitigates the perks of timing the market. Don't forget that the 4% each year applies to the previous year. Meaning, say, year 0 the depreciable base is 800,000. And 2% of that is 16,000. For the year 2 depreciation, the new depreciable base is 800,000 minus 16,000. You do 784,000 times 4%. Year 3 your new depreciable base is 784,000 minus 31,360, then times 4%. So on and so forth. In the end, the difference between Canadian and American depreciation is how constant it is. In the US, it's just the value of the building divided by 39. And that amount is the depreciation for each year. It's constant and predictable. In Canada, it's a percentage. In year 1, you can depreciate 2% of your building. In years 2 to infinity you can depreciate 4%. Since it's a percentage, it holds more weight as the property is valued higher. So, a shorter hold generally has the most benefits in Canada before the property loses too much value and the percentage becomes meaningless. 4% of 1,000 is much more than 4% of 800. Think about it. Thanks for watching and supporting the channel. Don't hesitate to reach out to us in the comments section if you have any questions.